Hello, everybody. I hope you're having a good holiday, or if you're working today, that's also great. Yesterday was Christmas, or a festive day for everybody, and I hope you guys enjoyed it. Time with your family, time with your friends. So I'm just gonna go over another trading video, this time with my voice, so you guys can go ahead and see the methodology of how to trade and how I do it. Now, disclosure, you will lose money. I don't know if I should put like a little photo in the front, but yes, you will lose money trading. So let's go. Today I'll be using Microsoft as the example and how this is currently still going. I'm just recording now. I have my stop loss set and so on. So, it's not really necessary to view the chart all day. Now, here I'm showing you how the blue line is the daily level high and low of that candle. So very simple. I'm not really scrolling back in time, data that, may seem important, but really it's not relevant. So I had a bit of trouble moving the line because the stop loss was there. But yes, those blue lines is the daily levels, and the red ones here are the pre-market high and lows. So if you're trading futures, this should be, the hours before pre-market or the hours before open. So as we see, the pre-market and daily levels, those act as our liquidity pockets. Now, liquidity in simple terms, if we really take it into the essentials of things, it is part of accounting. And in accounting, the most liquid assets is recorded first, like cash and whatever can be sold quickly. And, that means that there's a lot of people ready to buy it or take it, meaning those prices have a lot of eyes and interest. So let's go ahead and see what the video is telling us. We see a bias and price. So that gray box signifies the first hour candle. Now this kind of gives us like an X-ray view of the chart. So, we do want to keep in mind the higher time frames. Now that indicator that I've shown in previous videos, is used as kind of a X-ray, like I said before. And, you can kind of have the fractal view of the 5-minute time frame. So as we see, the directional bias is made as soon as the 5-minute candle closes under the IDR. So what exactly is the IDR? You can go ahead and see that in my previous videos. I do encourage you to watch those. But the IDR is basically the wick of the 1 hour candle. So whenever price breaks under that 1 hour wick, we can kind of, make that our directional bias. Sorry. Now here, I'm explaining what I just said, where we see that break of the IDR, and we have that price that we kind of want it to go down. Then this kind of uses the higher time frame viewers and the smaller time frame viewers, kind of puts them together, and it's kind of like an edge. So we do see that there are pre-market high and lows under and above the IDR that is broken. So that is good news for us, meaning that we can use this as a grade A or grade A plus entry. Now, what does these liquidity pockets mean for us? So once we see a break of that directional bias, we do want to make sure that there is a liquidity pocket on the bottom, meaning, it's a high or low of the pre-market, high or low of the daily, either one. If they are under, that is good news, because that's kind of like a target that other people are watching as well. Now let's go ahead and see what we're going to go ahead and explain. So as we can see, we have our entry there at the IDR, or a bit under it. Okay. Also for your stop loss, I put that on the opposite side of the IDR. Meaning if we have a bearish bias, I'd put that on the top wick of the hour candle. And we can see here how price is kind of respecting that direction. Yeah, now we can watch price a bit play out. Now I have seen this recording. I did just take it a few minutes ago. So this is price action that I've seen. Now the price is still moving live at the moment, and you will see a screenshot of the results. Yeah, following the video. So I hope you stay till the results are shown. Now, as a stop measure, actively, managing your risk while it's open is one of, if not the most important piece. So, what can you do to, ensure that you have profit, or ensure that you at least, took advantage of the play? So, as you see here, I've placed that you can use a trailing stop for 5% if that is your preference. Everybody has their own trading styles. If you'd rather, secure profit that way, or placing your stop underneath your entry in order to make it less, or I guess make it a no risk trade. Now that they all have their pros and cons. I'm not gonna say which one is better, because really there is none that's better than the other. But personally, I like to hold until it touches my stop loss or my take profit. Now, as we see here, yeah, so I'm gonna go ahead and explain, because we do see different setups, and we want to at least understand what the price is telling us. So here we have a situation where the IDR can be broken above without having a liquidity pocket, such as the daily or the pre-market high and low above or below. So as we see here, this is Meta. Meta has broken the directional bias above, but it does not have a liquidity pocket that it can reach, meaning it's kind of blind. So if this is interesting, because you might be like, oh, well, we broke the directional bias, why don't we buy? Now, you can, and this is, I'll explain it a bit more forward. Like here in SPY, you can go for a liquidity pocket buy in order to make the IDR your target. Now, I don't really recommend that. I don't recommend anything at all, but it is more high risk and can be used as that price just cannot be respected, or there's different results that can vary, so you can go ahead and use a liquidity pocket to reach your IDR that has been broken in order to kind of retest it in a way. But I usually just steer clear from those and just, have a directional bias, go to a liquidity pocket that is, in the direction that it's going. Let's see, like if you see here is saying that you can play this movement, entering at the liquidity pocket and exiting at the IDR. Now, reason I do this kind of takes a bit of concept from ICT. Now, I personally do not watch or trade ICT concepts, smart money concepts, any of that. I don't see the point in overloading your mind with information about like little moves, or I guess the accumulation, manipulation, distribution, all that. Like it's okay, you can trade what works for you. But I do take a bit of the philosophy where there are buy sell, well, there's buy stop liquidity and sell side liquidity. Yeah, meaning that as price, there's a level, there are orders that are pending underneath it that if they are executed is served as liquidity for other people. Now, I kind of like that concept as you can move and take advantage of whoever's doing that play. You can kind of activate the stops in a sense, going in the direction, because there are going to be a lot of people that try to reverse these IDRs, because on higher time frames they may see, oh look, we're bouncing off of the higher, like the 1 hour, top, or the 4 hour top. Maybe it might be that. So there are a lot of eyes looking to go against the price. And this is what I really like about this strategy, is that it takes advantage of all those orders that are expecting a reverse, kind of to, like, if there's enough pressure to break it, that means that there's something of value there. Now, where we're going to go over here and enter Google. Now we have, or if you saw it right now, we did enter Google. And why we do see that the directional bias was broken, and we do see that there are liquidity pockets underneath price, meaning we have a direction and we have a target. So as we see Google break that directional, you have the grade A plus, the grade A, and the grade A minus entries that you can take. Now grade A minus is more for the scenario that I've listed before, where price does have a directional bias but without a liquidity pocket above or below. So this is where we're using grade A, just grade A entry, where we see the price has break-in and we decide not to use a limit order. Now, what makes a grade A plus different is that just the limit order being placed on the liquidity pocket. So with Google, I have just entered just off the price action. It seemed very close, and I wanted to short in order to reach that daily low level. So as we see, we will see price bounce around that level and reject the pre-market high or the pre-market low, meaning this is good for shorts according to our strategy, and you may use this in confluence with indicator of your choice. I personally decided not to use any additional confirmations, as I find myself going into analysis paralysis. So now there are different ways you can play these movements, is with either options trading or using margin. With options trading, you have a strike price that you'd want price to reach, in a sense, betting that price will reach that price, or the stock will reach that price. Now you may or may not know, but options have what's called the Greeks. Now that's what separates them from the different type of contract that I'm going to be talking about. And here in the video, you can see that I'm explaining the way you can grade your entries, which is just differentiating between a limit order and a market. So how can what is the Greeks on options? So options expire on the contract dates. So you are going against time and kind of this thing called volatility or implied volatility, meaning this is like how many people are expecting a price to go up or down based on, I could be wrong, based on how much contracts are being bought. So, what this means is you can, this is more for bigger balances where you can have, you can find ways to work around it. But with the higher balances, you're able to risk more at the appropriate strike price that you'd want. With that, options, your only risk is contracts you buy, so you can't lose more of your accounts if you do not play it. For margin trading, for margin traders, that's people using features, people using contract for difference, or people in just using stock itself. Well, even though, no, it's just futures and CFDs traders. You use what's called lot sizing, and you risk however much you want to leverage. And my apologies, I'm putting on my braces. And that kind of lets you risk more on one side and kind of measure it easily. So what I personally do is use stock futures or stock CFDs in order to balance my risk reward easier, simply just because it's easier to find out the risk that off the single trade instead of. What's that? Yeah. So price is easier to control on the risk side, because with certain contracts you're not able to really gauge how much you risk if it hits your stop. So yeah, that's basically the video here. You can go ahead and watch the rest. I just wanted to give my voiceover commentary, just to make it, easier, more personable. So I hope this video does help, and later you will see price movements. So if you made it this far, sounds good for you, because you are learning a lot, and this is really the most basic way to understand it. So thank you. Goodbye.